Hello, everyone, and welcome to Teachly University. And in this lecture today, we're going to be discussing how it is we can get rich and accumulate wealth with just one simple stock market strategy. And I'm a big advocate of keeping it simple. And I think simplicity is your best friend, especially when it comes to your investments and accumulating wealth over time, because the financial industry has done a very good job in convincing you that you're not smart enough to be able to make wealth or generate wealth on your own in the stock market, that you need financial advisors, you need other professionals, quote unquote, in the financial industry in order to be able to take care of your finances. But I think after this lecture, you'll see that, in fact, to be able to generate wealth in the stock market, there's a simple and powerful way to do that. That isn't exciting, that isn't sexy per se, but it is a very effective way to generate wealth over time. And the reason why it isn't seems sexy at first or exciting is because today you watch the financial news, or if you're tuned to social media, you see that the stock market today, the way it's been portrayed, I think thanks to a lot of influencers um, and others within social media and the financial services industry, it's become more of this casino in a way. And I don't like using that term to describe the stock market, but I think in some ways it could be described as such, because I think there's a lot of short-term activity when it comes to trading the stock market. You see a lot of day traders and short-term traders where people buy and sell securities within just a few months, a few weeks, or even just within a day or a few hours. These high-frequency traders where they just trade, buy, and sell stocks within a short period of time. And there's this sort of belief, and we only see the front end of this, that this sort of euphoria when it comes to investing, or excuse me, trading the stock market, where with just a click of a mouse, you'll be able to generate vast amounts of riches beyond your wildest dreams. And you see that a lot on social media, where a lot of these influencers, they show off their Learjets and their Ferraris and their huge multi-million-dollar homes, and you see only the front end of this. And it creates this sort of euphoria and excitement that you can get wealthy with just a few clicks of a button, or get wealthy very easily with very little effort in a short amount of time. And what this creates is something called, and I'm borrowing this term from Alex Hormozy, is uninformed optimism. So what does this mean? Well, how often as I've said before, we go on social media, or we hear from friends and family and coworkers, that we hear about friends of ours that maybe have started a business and they've made vast amounts of money, or they made money in the stock market and they made millions of dollars trading crypto or Bitcoin or stocks or meme stocks, whatever that may be the case. Or we hear how somebody started a company, an online store, and they've an e-commerce store, and they've managed to make millions of dollars. So this creates this excitement that when we hear this, like, oh wow, they made so much money, it seems so easy, and maybe I can do that too. But the problem is, as I've just described, this is what's called uninformed optimism, because we see the front end of all this, all the quote unquote success, but on the back end, the real true story is that for a lot of the entrepreneurs, for example, who've managed to become very successful, that we don't hear is all the steps and all the activities and all the work that they had to put in starting that business. It wasn't as easy as it sounded. We just hear the success stories behind this. And the same thing applies to when we hear people do very well in the stock market and day trading, or trading the short term, is that the vast majority of short term traders, people that go in and out of the market, that buy and sell securities in short order within a short period of time, end up losing lots of money. This sort of speculative frenzy that I think really describes how a lot of individuals treat the stock market. It's sort of speculation. There's no research. There's no discipline tied to their strategy, or lack thereof. There really is no strategy. And as a result, they end up losing lots of money. So just to pull some data to dive into this a little bit, the average individual investor underperforms the stock market, market index, by about 1.5% a year. These individual investors, the average investor, usually will buy individual securities and may hold on to them for a couple months, maybe a few years. They sort of just bought the stocks because a friend told them that was a good idea, or they just bought it because of some news that they saw on CNBC, and they purchased the securities. Then you have active traders that underperformed the market by about 6.5% annually. These are people that buy and sell securities within a few months, a few weeks or days, or even just within a day or a few hours. These are people that are constantly buying and selling securities consistently. And we see they underperform the market. Now, let's dive deeper into this. Poor individuals tend to spend a greater proportion of their income on lottery purchases, and their demand for lottery increases with a decline in their income. I mentioned this data point because I think a lot of people that enter the stock market treat it as some sort of lottery or casino. They make a bet, they put a certain amount of money in, thinking that if they just with just, as I said, a click of a mouse, buying some securities or some shares of stock, that they're going to make vast amounts of riches. And it's this sort of lottery mentality where they're just hoping that something happens with sheer luck. And to get into a little further into this, within each income group, gamblers consistently underperform non-gamblers. And this makes a lot of sense because gamblers don't have a strategy. Gamblers essentially just go in with wishful thinking, hoping that they can actually get lucky and make money. And I think that's why a lot of people treat the stock market as a casino. It's just this, they close their eyes, they roll the dice, hoping that something happens or something good happens. And unfortunately, that ends up not being the case for the vast majority of people, even who just buy individual securities, even just your vanilla large cap stocks. Over time, it's just very difficult to beat the market, essentially. And this especially holds true with those that treat the market as essentially like a casino and this gambling-like speculative behavior. So then what is the option then if buying individual securities or trading in the short term really doesn't help you beat the stock market? Well, the other option, of course, is mutual funds. Now, what is a mutual fund? For those of you who don't know what a mutual fund is, it is a type of fund of investment company that pulls money from many investors to purchase a portfolio of securities. The fund's manager, known as fund or money managers, decide which securities to buy and when to sell. Investors then purchase shares in the fund, with each share representing proportional ownership stake in the fund and its company and its income. So mutual funds is a very common investment vehicle that a lot of folks use to grow their wealth over time. We see this in 401ks, et cetera. Just a common investment vehicle. And they've been very popular for decades, for quite a long time. But the problem with mutual funds, as you'll see, even though I think they're certainly better than I think some of the other strategies that we've seen, that's more along the lines of speculation. Mutual funds, for the most part, just aren't very effective in growing your wealth. And this is actually an article that I found from the New York Times showing that mutual funds that consistently beat the market, they raise this question, is not one mutual fund they found within the last 5 years, all 2,100 of them, have not been able to consistently beat the stock market, okay, which is very telling. And again, to dive into this, over the last 10 years, only 10% of mutual funds saw more than half of their stock picks beat the index. This means that 90% of funds picked more losing stocks than winners. And just between 2013 and 2023, 90% of funds picked more losing stocks than winners. Now, this doesn't even include the fact all the fees that are tacked on with mutual funds that eat away at your returns. So when you look at this, and what's striking is that these mutual funds are managed by professional money managers. These are supposedly the best and brightest people that went to Ivy League, that are supposedly the best stock pickers, the professionals that we're told that know what they're doing, that they want to be able to handle our money for us. But we see that consistently they're just unable to beat the market over time. So what can we gather from this? Well, trying to beat the market is a fool's errand. If you think that you're going to be able to beat the stock market and generate returns that surpass market returns over a period of time, odds are you're basically, it's a fool's errand. You're not going to be able to succeed. If the professional money managers aren't able to do it, then chances are, for people like us who aren't in the industry, who don't even have the resources that they have, it's going to be very difficult to beat the market in the long term. So then, how can you create wealth in the stock market if we see that buying individual securities over time, it makes it difficult to beat the market? Of course, day trading or short-term frequency trading isn't effective, or even with mutual funds, we can see that mutual funds aren't effective in helping generate wealth. Then what is the alternative? Well, To go to John Bogle, he said that the simple fact is that selecting a mutual fund will outpace the stock market over the long term. Is using Cervantes' wonderful observation, like looking for a needle in the haystack. So I offer you Bogle's corollary, excuse me, I had a hard time pronouncing that word. Don't look for the needle in the haystack, just buy the haystack. Or to use the casino term, okay, buy a portion of the casino and benefit from its returns. Okay. So what John is saying here is that if we want to be able to generate wealth over time, we want to be able to capture and own a percentage of the entire US economy or a portion of the stock market. Okay. That comprises of all the major publicly traded companies in the United States and around the world. So how do we do that? Well, we do that through a vehicle called an index fund. So an index fund is a type of mutual fund or exchange traded fund. An ETF is sold like an individual stock that tracks the performance of a market index. The goal of an index fund is to mirror the index's holdings, activity, and return. So index funds can track different market indexes such as S&P 500, Russell 2000 Index, or Wilshire 5000 Total Market Index. So basically all an index fund does is mimic and track the performance of indexes like the S&P 500, which consists of the 500 largest companies in the United States, which is really the most popular index to be able to use and to be able to generate strong returns over a period of time. Okay. So basically all you're doing is you're just basically buying a portion of the US economy. I think that's a very broad sort of way to describe an index fund. That's really what you're doing. You're buying a piece of the US economy, which to this day is still the largest and most robust economy in the world. And it makes sense that over time, we want to be able to own a portion of that. Okay. So rather than trying to pick winners and losers, you just want to capture the return of the entire US economy, the stock market. So what's really the problem with this, with an index fund? Well, the problem is, actually, before we even get to that, okay, let's dive deeper into the benefits of an index fund and how powerful it is to be able to generate wealth and returns over time. So let's say, for example, if you were to invest $10,000 in, say, an S&P 500 index fund, okay, and you compare this to, say, an active fund, which is just another way, a fancy word of saying a mutual fund, you can see that over time. Now, if you just leave the $10,000, you don't do dollar cost averaging where you're just plowing into the index fund every month, you're putting money in that account every month. Over time, let's say in 20 years, that $10,000 will turn to about $70,000 over time. Okay. You compare that to the index fund, or excuse me, the mutual fund, you'll get about roughly a little over $20,000. So you could see by far, when you account volatility, that an index fund is far superior to that of a actively managed mutual fund over the long term, and how powerful it is of a vehicle to be able to generate wealth. So diving into this then, the average annual return, say, of an index fund is about 10.54% per year. Compare that to a mutual fund, which is about 5.21%. Huge difference. Okay. And how over time, through the power of compound interest, using an index fund is a very cost-effective way where there's very minimal fees when using an index fund. We'll be able to help you generate wealth over time. So what's the problem then with this? Now let me finally get to this. So what is the downside with an index fund? Well, it's boring. Okay, that's really the problem, that it's not exciting, it's boring, and it's really just you're competing psychologically against other strategies that are much more exciting, but just don't yield the same amount of returns. Okay, it's boring, and the problem is that we have to fight off what's called shiny object syndrome. So what does this mean? Well, what this means is that in order for indexing to work, for passive investing to work, you need to stick with it over time. But what ends up happening is that we come across the next best trading strategy, or the next crypto or Bitcoin or cryptocurrency or trading strategy that allures us into using that, because we're told of stories that of how people made so much money using this crypto investing in this crypto or using this trading strategy, it becomes very alluring. So, and this happens in entrepreneurship as well, where we're starting a business, but then we see this other opportunity. We think, oh, I got to do this, and then we end up trying to do all these different things, start all these businesses, try to invest in all these different types of strategies and investment vehicles, but we end up deluding ourselves, and we just don't stay focused and stick with a plan that over time can yield vast amounts of wealth. So it's about simplicity. It's going back to what I was saying here. Doing the boring activities every single day, combined with focus and applying learning, can, over time, bring you riches beyond your wildest dreams. And actually, let me go back to, which I actually didn't read this quote, the first quote from John Bogle. Sorry, just going back here real quick. Who says an investment in knowledge always pays the best interest. Learning is to the studious and riches to the careful. If a man empties his purse into his head, no man can take it away from him. So to generate wealth, it's not just about simplicity. It is about working on ourselves. The hard work that we want to apply when it comes to generating wealth isn't so much in our work and what it is that we do, but it's in ourselves. It's in our personal development and developing the discipline and the knowledge to stick with a plan that is simple yet powerful in generating wealth in the long term. And that will pay literal dividends in the long term. So that's really what I want to hit home today with this lecture, is how keeping it simple and using, I think, indexing, this very simple but powerful strategy in being able to generate wealth over time. So I hope you enjoyed this video. Make sure to hit that subscribe button so you can watch all my lectures on wealth building and personal development and entrepreneurship. And I look forward to seeing you in the next video. Take care. Thanks.